Today, I will gonna take you through Introduction to Leases, IPSAS 43. My name is CPA Yusuf. IPSAS 43 has replaced IPSAS 13. Initially, what used to happen was we used to expense, for example, all leases or all rental payments. Currently, or under IPSAS 43, you yes, there is an expense involved, but in the books of lessee, you will treat it as a finance lease, whereby both the assets will be recorded, both the asset and the liability will be recorded in the statement of financial position. In the books of lessor, things will remain as per IPSAS 13, which used to have operating and finance lease. There is the main reason that we are recording this as finance lease is because, for example, assume that the government has 5-year lease, a uniform 5-year lease of 1,000 offices, each office costing 50 million for different entities, say even 1,000 entities and 1,000 offices, and each one costing 50 million for 5 years, so 10 million each year. Suppose the government pays the first 10 billion. What happens? The government will remain with 40 billion. That 40 billion, if it's not captured in the balance sheet of the government, then that is not true and fair view reporting of financial statements or financial reporting. So there is a gap, or there was a gap as a result of not reporting those material figures in our books. Now, with IPSAS 43, the need for that is covered because you'll be recording both. We'll be recording both the right of use asset and the liabilities. I will start with my outline and beginning with my introduction. Then I will go to key definitions, move to identifying a lease. Or are all contracts a lease? So when we reach how to identify a lease, we will know whether a contract is a lease or not. And then we'll move to Lessee Accounting. We said all Lessee Accounting, they will treat it as like a finance lease. And there is no operating lease in this. But in the Lessor Accounting, we will have both financing and operating lease in the books of Lessor. There are some parts which I have not captured in my outline. Since this is just an intro, I will cover in my next presentations where we will cover sale and leaseback transactions, lease modifications and remeasurement. I will also cover each of these major headings, identifying a lease, lessee accounting, and lessor accounting as a separate presentations with real-life examples for better understanding on each. If you look at that picture, you will see that this is a lease agreement. A man carrying a lease agreement on one of his legs. Maybe it is glued to him. That man is riding on a unicycle. What do we know of unicycles? They are hard to drive. A unicycle is also a direct drive. Direct drive means that the pedal are attached directly to the axle. No gears, no chain, no brakes. So you can easily fall. And then there are images of fire. Assuming those are fire in your car, that what will happen? There is high chance you will burn those papers, those lease agreements. For us, accountants, we rarely read those books or those contracts. Now it is time to read them, unless we are throwing them in the dustbin. And that is something which is a weakness to most accountants. So IPSAS 43 came because of the way we used to treat leases. We used to just write off those expenses. No liability, no right of use asset. Since you have a liability in your books, if you have entered into a contract for more than 1 year, and those liability are not recorded, then you are not showing true and fair view of your financial. One example of a company that died because of off-balance sheet accounting is Enron. Enron was growing and became one of the top most or best performing companies in mid 2001 in USA. But then abruptly they fall because of off-balance sheet accounting and what's known to be market accounting. There were used to be five biggest audit firms. Currently we have four. They used to be PwC, Anderson Worldwide, KPMG, Ernst Young, Deloitte Touch. Now we only have what? We have PwC, KPMG, Ernst Young, and Deloitte. Anderson died with Enron. And because of how they were handling their financials, so there are casualties when you don't make proper books of accounting. So this off-balance sheet accounting, before it kills government, because for public entities and others, then it will be wise for us to put those in our financial statement as lease liability and right of use asset. So this is the reason why IPSAS 43 came in with a helping hand and a fire extinguisher to extinguish these fires you are seeing before it burns those lease agreements. And then we balance our books. We balance our books. Once you recognize this liability, if an item has a debit as an accountant, we normally know that there is a credit side. So the liability is balanced with the right of use asset. So this will extinguish the chaos brought about by writing off those leases under IPSAS 13 or off balance sheet accounting under the previous IPSASs. This will help us and will help and solve many problems. It will also aid the users to understand the liabilities and the right of use assets for our entities. The objective of this standard is to set out the principles for the recognition, measurement, presentation, and disclosures of leases. The objective is to ensure that lessees and lessors provide relevant information in a manner lease faithfully represents. Lawyers can say what they want, politicians can say, but accountants, there are many lives that depend on us. Those statements, those general purpose financial statements, GPFS. So we have to represent, we have to provide information that is faithful, that is true and fair in this financial statement as much as we can. The scope, an entity shall apply. We shall apply this standard. All leases, including leases of right of use asset in a sublease. Even if you have a sublease and there's another lease to that sublease, you apply this standard, except those covered under other IPSASs. What are these other IPSASs? There are leases covered under IPSAS 27, agriculture, for example. There are leases covered under intangible assets, IPSAS 31. There are leases covered under concession, service concession contracts under IPSAS 32. Those leases, those are not covered under IPSAS 43. Those leases are not covered under IPSAS 43. So unless it is covered under other IPSAS, then all other leases not covered in other IPSASs are covered under the scope of this IPSAS 43. So there is, in my introduction, leases. Lease. A lease is just what we normally do in our day-to-day life. You can either be a tenant or a landlord. When you lease a house as the owner, you are the lessor, you are the landlord. When you use that house, you are the tenant. So the lessor and the lessee. So leases have two components, lessee and lessor. The lessee legally owns that asset. You can own the asset by in several ways, by building yourself, inheriting, buying yourself, in several ways. The lessee is the person who uses the asset. What does the lessee pay? Is it for free? Rental payments. Those rental payments can be in advance, which is at the start of the lease period, or in arrears, which is in the end of those lease period. Again, if you are looking at from an entity's perspective, that could be some form of property, plant, and equipment. So somebody owns that property, plant, and equipment. It could be a warehouse. It could be the head office, and the entity leases the asset from whoever who owns the head office or the warehouse. It could be a piece of equipment. It could be even a car or land. The way in which this works is that the lessee makes regular rental payments to the lessor. It can be annual regular payments, monthly regular payments, quarterly or weekly or fortnightly. IPSAS 43 guides that the lessee to treat the asset as though they temporarily own in their books. The underlying asset is recorded in the financial statement as right of use asset and with a lease liability on the credit side. We are not stopping there. This IPSAS 43 also recognizes interest as this is the amount that you committed to pay in the future. So there is an interest factor which is captured in the statement of financial performance. Depreciation is also calculated from the right of use asset on a straight line basis. So there are so many things. Initially, we used to have only rental expense, rental payments or lease payment. Now we have what in the books of lessee? We have right of use asset. We have the lease liability. We have the interest factor. We have the depreciation factor. So there are several items which we need to look out on how to treat in our books, in the statement of financial performance, in the statement of financial position, in the statement of cash flows. So each one we will go deeper in our next lessons. So before you go to lease, there are some things which you normally consider: buy or lease that car, and you want to use that car or you want to have that car. You consider, should I buy or lease? If you want to buy the car, then your aim is owning the car. If you want to lease the car, the aim is returning the car, unless you are using finance lease in the books of lessor. So how can you own the car? By paying everything upfront or taking a loan. How can you lease? Paying rental payments for a period. Then there is something called finance lease. Finance lease is something in between taking a loan and owning the car and also leasing. So you will find that in finance lease, you are not paying for the loan upfront or deposit, or it's not a loan, but it is a form of loan. So it's just as similar. So for you as an entity, you need to consider all these factors and see which one is the most convenient and the cheapest alternative among the four alternatives. Should I buy or lease? It's up to you to decide as the top management of your entity. So lease examples, we spoke of office space leasing, equipment leasing, motor vehicle leasing, land leasing, public-private partnership. What are these? These are often structured through lease agreements. For example, a government might enter into a long-term lease with a private company to build and operate infrastructure such as roads, bridges, houses, or hospitals. The private entity finances and manages the construction and operation, and the government leases the use of those facilities for an asset period. So that's called public-private partnerships. So an entity can have office lease, space leasing, another one equipment, another one can combine all these leases. So these are some of the examples, but not limited to this. They can go beyond these 5 examples. How do we identify a lease? When you are trying to figure out if a contract is actually a lease, think of it as determining whether you are just borrowing something or you are getting to use it as if it is your own. So, an identified asset. Lease, any lease contract must contain these 3 elements. There must be an asset. If you enter into a contract with a cleaning company, is that a contract? Yes. But is it a lease contract? No, because there is no identified asset. If you enter into a contract with someone, buy goods for consumption, is that a contract? Yes. Is it an asset? Yes. But it is not an asset that can be leased. Reason because the purpose is for consumption, not leasing food consumptions. So there is different types of assets and different types of contracts. The right to obtain substantially all of the economic benefits or service potential. Economic benefits or the service potential is the keyword here. So if you cannot obtain the right of economic benefit or service potential, what is this? This is about whether you can reap the rewards from using that asset. Say you are leasing a printer for your office. If you get all the benefits from using, say, like printing your reports and marketing materials or similar items or whatever you want from that printer, if you can use and get economic or service potential from that printer, then you are enjoying the right of you're enjoying the right to obtain economic benefits. And finally, the right to direct the use of the identified asset. Still using the example of a printer. If you can decide what to print, when to print, and how to use the printer in general, you can use the printer wherever you are, since you have leased it. Then you are truly have control over it. It is just like you would if you owned it. But if any of this is missing, then that is not a lease contract. We will go to the next examples, and in those examples, we will identify if it's a lease or not. A coffee company enters into a contract with an airport operator supplier to use a space in the airport to sell its goods for a 3-year period. The contract states the amount of space and that the space may be located at one of the several boarding areas within the airport. Supplier has the right to change the location of the space allocated to customer at any time. So the supplier can change the space at any time during the period of use. There are minimal costs to supplier associated with changing the space for the customer. Customer uses a kiosk that it owns that can be moved easily to sell its goods. There are many areas in the airport that are available and that will meet the specification for the space in the contract. So is this a lease? The answer to this, even though the coffee shop can sell goods and make money, they don't control where the shop is located. The airport does. So you can't control so there's no identified asset. So this is not considered a lease because they don't have the right, yes, the next one, to direct the use of the specified. So there's no identified area and they can't direct the use of the specific identified area. Again, this is another example. Customer enters into a 15-year contract with a utilities company supplier for the right to use 3 specified physically distinct duct vipers within a larger cable connecting Mombasa to Kisumu. Customer makes the decision about the use of the vipers by connecting each end of the vipers to its electronic equipment. Customer lights the vipers and decides what data and how much data these vipers will transport. If the vipers are damaged, supplier is responsible for the repairs and maintenance. Supplier owns extra vipers but can substitute those for customers' vipers only for reasons of repairs, maintenance, or malfunction, and is obliged to substitute the vipers in these cases. Is this a lease or not? Yes, it is a lease. Here, the company has specific vipers assigned to them and controls their use fully, making this a clear example of lease. This one has all the three examples or all the three conditions we said. There is an identified asset. So physically distinct like vipers. Someone is enjoying economic benefit. Right to direct its use. All those three I have mentioned in when identifying a list are all present in this example. So lease accounting by lessee. First, how do the lessee account for? Fixed payments. Fixed payments, just like a subscription fee. These are the payments you agree to make regularly, monthly, yearly, etc., which don't change over the lease term. This could be likened to your fixed monthly rent for an office. Variable payments. Variable payments. Sometimes you make payments can change based on external factors like inflation. If your lease payments are tied to such an index, they can go up or down accordingly. It's similar to a cell phone plan, which where charges might vary based on data usage or service fees linked to inflation. The next one is purchase option. So the exercise price of a purchase option. If your lease agreement gives you the option to buy the leased asset at the end, and you are pretty sure you will buy it, the cost of this purchase is included in your initial calculation. Residual value, amount to be payable by the lessee under residual value guarantees. If you promise to pay a certain amount at the end of the lease for the asset, depending on its value, then you will include in your calculations. And finally, penalties. And this penalty is if you are sure that you will cancel. If the contract contained that if you cancel within uh, after 10 years or 5 years that you will pay a certain amount, and you know that you will cancel that contract, then that's also will be included in the initial lease calculations. So these are the 5 ways to calculate this. Each lease agreement may not have all the 5, but some will have majority of these 5. Lessee accounting by lessee lease term. To calculate the initial value of the liability and right of use asset, the lessee must consider the length of the lease term. IPSAS 43 says that the lease term comprises the non-cancelable period. So if you have agreed with the lessor the lease period to be 10 years, but you can cancel after 5 years, then the lease term is the 5 years, which you cannot cancel. The other one is optional. Period covered by an option to extend the lease if reasonably certain. If you have agreed with the lessor that the lease is 10 years non-cancelable or 10 years plus an option to extend for 5 years, which is 15. But you are certain that you will fulfill that or you will extend that option and you will pick that option. Then the lease term is the 15 years. Period covered by an option to terminate the lease if you are reasonably certain that you will not terminate the lease. So if the lease is 15 years, but then in year 10, the contract gives you to terminate, an option to terminate. But you are certain that you will not terminate. Then the lease term is 15 years. So it depends with clearly reading. The lease term is an uncancelable or an option to extend or an option not to terminate. Lease accounting by lessee, initial right of use. So once you have calculated the lease liability and you know the lease term, at the commencement of the lease, the lessee recognizes the right of use asset and lease liability. So how do we get the cost of right of use? You start with amount of the initial measurement of whatever we have calculated in the initial lease liability. You will start with that, the present value of that. And then you add any lease payments made at or before the commencement date. Anything you made in advance, you add back. And then, because first we had the initial lease liability, so add what you have made in advance. And then initial direct cost incurred by the lessee, less any lease incentives. So you remove any lessee incentives, but add any direct cost related to that lease. And then you also add cost incurred by the lessee. This is the provision for dismantling, removing, and restoring the underlying asset. You have leased an office space. You have included the initial direct cost of building that office, partitioning, and then or transporting the materials and everything, or whatsoever that any cost that's directly related to that lease. And then you want to remove whatsoever you have done at the end of the contract. So any cost related to dismantling, removing, restoring the underlying asset to its initial state, then that will be included as the cost of right of use asset. When reducing the cost of right of use asset or the right of use, you depreciate using the whole lease term period. When reducing the lease liability is through payment. As you keep paying, the lease liability reduces. As you keep using this right of use asset, you depreciate depending on the number of years or the useful life of that asset. So here is our calculation. Entity XYZ, how do we do this calculation? Entity XYZ has entered into a 10-year lease for a floor of a building with an option to extend for an additional 5 years. The annual lease payments are current unit 50,000 during the initial term and increases to 55,000 during the optional extension period, payable at the beginning of each year. So the keyword here is at the beginning. So this in advance. Entity XYZ incurs initial direct cost totaling current unit 20,000, which includes current unit 15,000 paid to the previous tenant, and current unit 5,000 as a commission to the real estate agent, with the latter being reimbursed by. So this 5,000 is an incentive. The implicit rate in the lease is interdeterminate. So Entity XYZ will use its incremental borrowing rate of 5% per annum, considering the lease term to be 10 years without the extension required. Calculate the right of use asset and lease liability. So when you are calculating the lease liability, since you have paid one in advance, first you will use this. This is my calculation. You will use the present value of 9 years for an interest of 5% per annum and lease payment of 50,000, because you already told that the additional option to extend those 5 years, the entity XYZ will not take up. And how much will I get? If you use present value in Excel, present value 0.5, 0.05, and then 9, comma, minus 50,000, you get what? 355,391. Remember, we are using 9, no, not 10 years, because the first one was paid at the commencement date. It is in advance. So you have remained with 9 periods. That's what we will be calculating. So those are our present value. So the 355. If you multiply 50,000 times 10, that's 500,000. But now, the maximum we will pay as a lease is 4 or 5. But ideally, what you will be paying 50 times 100,000 is how much? 500,000. So why, if we were paying the rental, we are paying 500,000. Why are you telling us we will pay for 391, even including the one we have paid in advance? The reason being, since it's in advance, the difference between the 500 and the 405 is the interest factor, because we are calculating the present value, and you know money today is not equivalent to money tomorrow. So the present value of 500,000 after 5 years is 405, of which 50,000 we have paid in advance. Now we are remaining with 355,391. So calculating the right of use, we will start with the lease liability, which is the present value of lease liability, which is 355, and then we add back the 50,000 which was paid in advance, and then we add any direct cost. The direct cost was 20,000 less any incentives, which was 5,000. Total right of use asset is 420, 391. If you look at the lease liability is 355, while our right of use is 420. Where How will I balance my books? You will balance because you have reduced your cash, increased your asset. You have paid 50,000 when you had the liability at 355. So you have reduced your cash, increased your asset. You also had direct cost. You reduced your cash, increased your right of use. And when you received an incentives of 5,000, even though it's like you have received cash, so you reduce your total right of use asset. Total right of use asset. This is an answer to the questions. You can read the question and understand. Lessor accounting. Lessor. Lessor accounting has two types of leases under IPSAS 43, either operating lease or financing lease. In financing lease, you debit receivables, it looks like loan, and credit net receivable. So in finance lease under the books of lessor, it's as if you are selling that item or asset. So you remove, but on debt, so you remove from your books. So when removing, you credit the net investment in that asset. The net investment is whatsoever the fixed, the variable, the penalty, the residual value, and everything. And then there is one part, the residual value guaranteed by the lessor. So you add the unguaranteed amount when crediting the net investment. So you debit receivables, debit the amount that is receivable. And as you receive, you reduce the receivable. You reduce until the receivable is out of your books. So an asset or non-current asset or a PPE, you always debit when you increase and credit when you reduce. So we are reducing the asset by crediting the net investment, and also increasing since there is an asset that went out, but you have not received totally in cash. So you are increasing by debiting the receivables, which is also another asset. And as you reduce the receivables, you increase your cash and credit the receivables. Operating. Operating is just straightforward. You get the lease payments or the income or the rental income. And revenue is recognized on a straight line basis. Straight line, when we say, is even if you have received rental payments or lease payment in advance for 40 years, 50 years, that revenue you want to recognize as the revenue for that year. You will say the total revenue divided by the number of years, and then you will get and recognize on a straight line basis. If you note, there is a difference between finance and operating lease. Operating lease, you may find that an asset is held in the books of entity B and also entity A. The two people are holding the same asset in their books. So that is called asymmetric accounting. While in the finance list, one asset is removed, the non-current asset is removed from the books of the lessor and recognized under the books of lessee. But this one, in operating, it is not removed from the books of lessor and it's also recognized in the books of, so that's called asymmetric accounting. So an example of operating lease. Entity X leases out a machine to entity Y. under a 4-year operating lease. The lease term are that the annual lease rentals are 4,000 payable in arrears as an incentive. Entity X grants Entity Y a rent-free period in the first year. Calculate the rent receivable in year 1 in the books of the lessor. So in year 1, you have given rent-free period, but we said you will recognize the rent or revenue systematically. So what you will do is 4,000 times 3 years. That's 20,000. And then the 20,000 you divide by 4. So each year you will recognize 3, 3, 3, 3, 3. So in year 1, the rent receivable is 3,000. Even though you gave that month for free, but the rent or revenue receivable is 3,000 and not 4,000. The next year, the rent receivable is 3,000. So in year 2, what's receivable is 6,000. But what you will receive is 4,000. So the other one is a debt or a receivable. Is it a finance lease? How do you differentiate between operating lease and a finance lease? A finance lease is when you transfer the risk and rewards to the lessee. So there are some elements we normally look at. Ownership is transferred to the lessee by the end of the lease term. So this ownership, you transfer ownership. In that way, it's a finance lease. The lease contains a bargain purchase option. If you read those lease agreements and the lease contains a bargain purchase, definitely it is a finance lease. Lease term is for the major part of the economic life of the asset. If it covers 3/4 of the asset, then it is a finance lease. The leased assets are of such specialized nature. If the item is specifically meant for you, then it is a finance lease, and it's not meant for any other person. So specialized nature, then it's a finance lease. Present value of minimum lease payment represent the asset fair value. So if the present value of that leased asset is 3/4 or 80%, then it is a finance lease. So ownership, bargain, life, specialized, present value. So anything that has these characteristics is finance lease. All others which don't have these characteristics are operating leases. Lease modification. A lease modification is accounted for in one or two ways. It is treated as separate lease, added one or more assets. If you add more assets, like for example, you have entered into a lease agreement. By the way, modification is the change of scope or consideration that was not part of the original lease. Examples of lease modification include changing the consideration, extending the lease term, shortening the lease term, adding assets, removing assets. So if you add more assets, more floors of that, more office spaces, then you can treat as separate lease. But if you just extend the term, then it's not treated as separate lease. Thank you for listening. This is the end of my presentation. In my next presentations under leases, I will cover those subunits or subsections so that I will provide more real life examples. This was just a walkthrough or an introduction to leases. Thank you very much and have a wonderful day.